All right, let's talk about Palantir. This is a company many people see as this, impenetrable AI fortress right at the heart of national security. But for investors, that fortress is on trial. We've got a really strong business, but a stock price that is just soaring, and that creates a major conflict.
So what is it? Is Palantir this revolutionary company that's defining the future of AI and defense, making it an absolute must-own stock? Or has all the hype just driven the price so high that it's become an incredibly risky bet? That is the big question we're going to unpack today.
And to get a clear answer, we're not going to just throw opinions around. Nope, we're going to use the time-tested framework of one of the greatest investors ever, Peter Lynch. His checklist is fantastic because it helps separate the really great businesses from the truly great investments.
Okay, first things first, the Peter Lynch scorecard. Let's just see how the business itself stacks up against his criteria. So, what kind of company are we dealing with here? Well, in Lynch's world, Palantir is a fast grower, which was by far his favorite category. With its long-term earnings growth pegged around 31%, it fits right into that sweet spot for companies he thought could become 10-baggers. So on this one, it's an easy pass. Mixed up, Lynch was famous for loving companies with a fat cash pile and very little debt. And Palantir's balance sheet, it's an absolute fortress. I mean, it is sitting on over $7.1 billion in cash with only about $230 million in debt. That means there's basically zero risk of bankruptcy, and it can fund all of its own AI expansion without having to come ask investors for more cash. That is another big checkmark.
And how about the business model itself? This is where Palantir is just so sticky. See, once a government agency or some huge company gets Palantir's software integrated into everything they do, the cost and the sheer headache of trying to switch to a competitor are just enormous. That creates these incredibly reliable long-term revenue streams, something Lynch absolutely loved. So that's a clear third pass.
So let's recap. A fast-growing business, a fortress balance sheet, and a super sticky model. It sounds perfect, doesn't it? Well, this is where the trial really begins, because after admiring the business, Lynch would then turn his attention to the price. And Palantir's price, it is screaming a warning.
3.61. What is that? That's Palantir's PEG ratio. And for Peter Lynch, this metric was the holy grail. Why? Because it directly compares a company's price tag to its actual earnings growth. It tells you, flat out, if you're paying a fair price for that growth. And a number this high? It's a huge red flag.
And here's where you can really see the disconnect. For Lynch, a PEG ratio under 1.0 was a good sign, a potential buy. A PEG of 3.61 is, in his world, just wildly expensive. It means that even though the story of the company is fantastic, investors are paying this massive premium that has just blown way past its already impressive growth. So when we look at the final scorecard, it's like a tale of two different companies, isn't it? On the business fundamentals, its category, its debt level, Palantir is a clear winner. But when you look at the valuation, at that PEG ratio, and how heavily followed it is by big institutions, it's a clear fail by Lynch's standards. But that just raises a huge question, right? If the stock is so expensive, why does the market keep buying it? And that brings us to the bull case, the very powerful rebuttal from the other side that tries to justify this high price. So yeah, why are so many investors willing to just look right past that classic valuation warning sign? Well, the answer isn't about Palantir's past. It's about a massive disagreement over its immediate future.
And here it is. You can see the disagreement right here. That 3.61 PEG ratio we were just talking about, that's based on Wall Street's consensus growth estimate of around 31%. But Palantir's own management, they've guided for a jaw-dropping 61% revenue growth this year. The market isn't ignoring the math. It's just using a completely different and much bigger number.
Okay, so where in the world does this explosive forecast come from? Well, management is pointing to three key things all firing off at once. A critical government contract becoming permanent, their new commercial AIP boot camps converting customers at a crazy rate, and this belief that their tech has finally hit an S-curve inflection point where adoption is about to go vertical.
Let's start with that first one, because Program of Record is a total game changer. What it means is that Palantir's Maven AI system is no longer just a temporary project. It's now a permanent, funded line item in the Pentagon's official budget. This gives them this incredibly stable, long-term foundation for their whole government business.
So this leaves us with two competing realities, right? We have the steady 31% growth story from the analysts, and then we have the explosive 61% growth story straight from the company. So let's try to put these two narratives together and figure out what a fair price for Palantir might actually be.
You know, when it's all said and done, it boils down to this one question. Which growth rate do you actually believe? Because your answer completely changes whether Palantir stock is a bargain or a bubble.
And the math here is just stark. If you go with the more conservative 31% analyst forecast, then a fair price for Palantir today is somewhere around $82 a share. That means it's pretty significantly overvalued right now. But if you believe management can actually hit that 61% growth target, then the stock is actually undervalued, with the fair price closer to $161.
This quote just perfectly sums up the entire situation. It's the classic dilemma every single growth investor faces at some point. You find a fantastic business, it's got a powerful moat, an incredible future, but you look at that stock price and you just scoff.
So what does all this mean for you, the investor? Is Palantir's premium price just a sign of market froth, making it smart to follow the Peter Lynch playbook and wait for a significant haircut before you even think about buying? Or is this the fair price you pay for a company that's on the verge of a truly historic growth spurt? That's the verdict you have to decide.